What's better for infinite banking, IULs or whole life policies? Chances are you've been sold this. There's a reason why. I'm going to be breaking down today index universal life policies versus whole life policies. What's better for actually building you wealth? What pays the insurance agent more? And this is coming from a guy who's not an agent, doesn't get a commission, and is just simply telling this to you for educational purposes because I've been exposed to the industry inside out. I know the truths that they don't want to tell you. So let's break it down all in this video. First off, 95% of policies sold in the United States are term insurance. Yep, Dave Ramsey, and he owns term insurance companies. VULs, variable universal life, which is a risk component attached to it, or IULs, index universal life policies. Now, here's the things that you're not told about IULs, okay? Up to 90% commissions for the advisor. I'm all for somebody making money, but I think it's kind of funny when the 90th percentile of insurance agents make $139,000 a year. Why are you listening to somebody that doesn't make money? Average is about $80,000 a year in that industry on how to make money. So first of all, let's stop getting our money advice from people that don't have money and get paid to sell you shit, okay? The second thing is your internal rate of return typically is only about 4 to 6%. Inflation historically in the United States is 2.65%, okay? And in the past few years, it's been higher, 5, 6, 7, 8, 9%. So why do you want to fund something that you're losing money in, okay? And secondly, that has hidden insurance costs. There are rising insurance costs as you continue funding an IUL that oftentimes are not disclosed to you, that year over year go higher and higher and higher and higher. So when you are capped, there are caps in indexed universal life policies, which means you cannot capture full market return. Then it means that as these insurance costs continue going up, which is a fact, and you're only able to earn this because there is a cap, you're just losing money. You are paying somebody this to lose money every single year. And a lot of times they're advertised as, well, we've got a 0% floor, which means you can't lose anything. Well, yes, of course you have a 0% floor because you're capped. So it's marketed to you as a benefit, and it pays the advisor 50 to 90% commission in year one when you fund your policy, but it's doing this for you, and then you have these hidden insurance costs, okay? This statistically represents 95% of life insurance policies sold in the United States, IUL, VUL, term. No wonder people think it's a scam. So the other option, especially when it comes to infinite banking, and by the way, most policies sold for infinite banking are this, okay? So the other option is your whole life policies. Now, the other crappy thing is most of these policies are set up wrong as well, or they're with inferior carriers. So what I'm going to cover is my strategy for using whole life. I'm going to show you why. I'm going to walk you through the details, and in a little bit here, I'm actually going to show you my personal wealth building strategy for generating at least 25% in annual returns that are very tax efficient. I'm also going to be giving away a copy of my book, American Mediocrity, a little bit later here, and I'll tell you the details on how you have a chance to win a free signed copy of that. And I'm really excited to get into this cash flow stuff where we are literally generating 25% plus in annual returns with really good tax strategy and really good exits. And this is something that you guys can straight up copy. Now I'm going to tell you a couple things about who this is not for. This is not for you if you are broke. If you are broke, none of what I'm saying here is relevant to you. You need to go earn more money, you need to decrease your expenses, and you need to be disciplined, okay? Now for those of you that are saving $600,000-800,000 a month, or you're making hundreds of thousands of dollars a year, or you're making millions a year, any of that pool, this is for you. So the reason that I like whole life is because I use a dividend-paying, high early cash value whole life insurance policy. I've made videos about this. I'll include the link to a couple of them in the description so you can check out other videos I've made on how to become your own bank and do infinite banking properly. The reason I love whole life is it's the only type of life insurance product where you can borrow against. So I've got leverage. When you're using an IUL to do infinite banking, you have to take out what's called a policy loan, okay? So if I've got $10,000 of cash value in my policy and I want to go borrow against it to invest in a cash flowing asset, I can't. I have to borrow directly from it. So it stops the growth. I lose my leverage and all I'm getting is eating inflation and taking inflation up my anus. Now, if I get a whole life policy, I can fund the cash value side. I can structure it as what is called a HEC-V, a high early cash value, which means I'm prioritizing stacking money in the cash side of it and focusing as little as possible on the insurance side of it. So it allows for faster cash accumulation, and within 60 to 90 days of opening the policy, I'll get access to roughly 70 to 86% of its cash value, and within another year, I get access to the full 100%. But take the same scenario here. If I've got $10,000 of cash value in my whole life policy, I can get a line of credit that is about 95% to 100% loan to value, all right? And this is going to grow at a really good rate rate, because in the whole life policies, you've got two components. You have a dividend and you have a guaranteed return. The dividend for the last 45, 46, 48 years has never been less than 6%. This dividend is tax-free. Now, it is not guaranteed. If an insurance company went insolvent and stopped being profitable, they would not pay that dividend. Now, we're talking about insurance companies that are older than Bank of America, Wells Fargo, Chase, all those big banks. So this has been around for a minute. This is pre-Civil War shit. You just weren't taught about it, probably intentionally. So I work with the companies that are the oldest in the business, that lent money to the JCPenney's of the world, the Rockefellers. What's the other guy? John McCain, he funded his campaign with this, right? I get a line of credit of 4 to 7%. But this here is growing at a 2 to 4% guaranteed return. And I'm also getting a dividend, again, I will repeat, has never been less than 6%. This year, it's 6.4%. I published another video on infinite banking not too long ago where I actually broke down the year-over-year dividends for the past 20 years with the top companies that are mutually participating, high early cash value, dividend-paying whole life insurance companies, okay? And so if I'm borrowing from my own money somewhere in this range, and I've got a dividend of 6.4, I got a guaranteed return of 2 to 4%, then I've got an IRR that supersedes an internal rate of return that is greater than my borrowing rate. So it's continuing to grow in value. It's gonna go up and up and up more every single year. And then I've got a line of credit against it, 100% loan to value. So if my cash value is now 20K, I raise my line of credit to 20. If it's 22K, 22. If it's 25, 25K, and I keep increasing my leverage. So this is the only type of platform, a whole life, that allows you to borrow against. When you do an IUL, you have to do a policy loan. So they're entirely missold and not designed to benefit you as well as they could compared to a whole life product. Now, a couple things you need to know about that. You want to do what the banks do. The banks have what are called bank-owned life insurance, or BOLI. And even the banks get this wrong sometimes. I know an advisor that just spoke with a bank, and they had a $73 million bank-owned life insurance policy that was set up with such a low internal rate of return that they were shocked when my buddy exposed them to this. And when he further exposed them that the advisor that had sold it to them had made about a 40% commission off of them. I would call that theft, to fund a $73 million policy and make away with almost 30 million bucks. That's legalized theft. The insurance companies let them do that. So what he did is he went and set them up with a bank-owned life insurance policy that is structured in the way that my policy is. It's an institutional grade, high early cash value policy, and that's what HECV stands for here. So you want to look at opening up one of those. Now, top carriers are Mass Mutual, Northwestern Mutual, Penn, New York Life, Guardian. Those are some of the top carriers. They've had historically the highest dividends. Mass Mutual has never been beaten, and I'll just break the ice right now. Chances are, if you go approach an advisor right now and you try to get one of these, they're not going to know how to set it up right, because there's only a few dozen advisors in the entire nation that are licensed to sell these, have been trained to actually sell these properly and set them up the way they are designed to have the highest cash value for you. So don't just go with your run-of-the-mill advisor and go make a call. I'll include some resources, because this is what we do every single day. I'm used to helping folks out with this, and I can at least point you in the right direction. So I'll include some of that in the description. So that's what you want to do. Now, before I get into the infinite banking strategy that I use to pull out 25% annual returns, I want to know in the comments, do you own life insurance right now? What's your experience with it? Or is any of the information I'm talking about here breath of fresh air from an unbiased standpoint for once? Because this industry is full of some crazy stuff, guys. And if you're brand new, consider subscribing so you're going to stay updated on all the strategies. We're talking about tax. We're not talking about your little IRA, your 401k that you got to keep locked away until you have to take Viagra to keep your dick up, because by the time you go to collect that, you're 60 years old, okay? We're talking about strategies that allow you to multiply your money and make your money have money babies, which is something I talk about in the book, and I'm going to tell you about the giveaway in a second here on that. We are all about helping you create and multiply money, create leverage, pay less taxes, and grow in a much faster way, because if you keep listening to this average advice, you're going to end up in the exact same place as mommy and daddy. Retired, can't afford to retire, living off Social Security, and not being able to keep up with rising costs of living, okay? You need to be able to build wealth, not stay in the middle class. So here is my strategy for actually generating 25% or more in annual returns with my infinite banking whole life policy. So if we go back into the history of the United States, there's 4 core industries that the entire US economy was founded off of, and that was railroad, right? You had the Transcontinental Railway that connected the East Coast to the West Coast. They met at the Golden Spike in Promontory, Utah. Pretty cool thing, pretty historical moment. So it's railroad. Then you got oil and gas. Then you've got mining, and you've got agriculture, okay? And part of that is also real estate, because we live on Earth. There's not gonna be more made. People need homes to live in, all right? So a couple of the assets I like to play in are oil and real estate. So here's an example. This is a deal that I'm involved with, and I'm gonna just cut the chase. You don't have to go source real estate deals on your own. You just work with vetted partners, people with a track record. That's what I do. And so this deal that we're bringing up right now, this is a 289 unit luxury apartment complex in Lenexa, Kansas. The average household income there is like $170,000 a year. This is like I know it's the Midwest, but this is like the Bellevue or the Beverly Hills, of Kansas City. You have year-over-year rent growth of 8 to 10%. So, take all the other markets aside. This is a recession-resistant economy because no job market makes up more than 15% of the economy. There's reasons I invest there. There's reasons we do deals there. There's reasons that we build apartment complexes. There's reasons we add on to existing. So this is a 289 unit. It's a 2.37x MOIC. And what that means, I'm just using round numbers. Somebody puts in 10,000, it's projected to do 23,700 in a 5-year period of time. Somebody puts in 100,000 in that deal, it's projected to do 237,000 in return for them in a 5-year period of time. So what that ends up generating is an 18.8% annual return. It's an 18.8% annual return. But remember our policy? We've got a policy that we're using to fund this. We got a line of credit that's 4 or 5%. Our policy is growing with a dividend and a guaranteed return, allowing us to achieve 8, 9, 10, 11%, okay? So we take this 18.8, and again, this is just projected. We like to underwrite things very conservatively here because if anything, when it comes to investors, you don't want to tell them, oh, we promised you were going to make 3x, but we only did 2x, right? So there's a lot of deals that we have done that are in this territory. This is a pretty good baseline. So if we've got an 18.8 over a 5-year period of time here, and then we've got a policy that's growing at 9%, okay? We're pulling in 27. We take out the cost of borrowing our own money, 4 or 5%. We're making 23, 24% in annual returns. Now, put that up against the retirement account, and some pessimist in here is gonna go, yeah, but you can't do that year over year over year, okay? Well, I'd rather do this and make 2, 2.2, 2.4, 1.8x than your retirement account traditionally making 7% in annual returns where it's locked away for 40 years and you can't touch it till you're 59 and a half. So who's smarter, okay? So I go in here, and then the other thing that I do is I go into oil deals. And oil deals are really cool. I've made other videos on the tax deductions and the tax incentives for these two assets. You do not have to be accredited to do this. You don't have to have high amounts of money. We're talking about working with capital of 25K or more. So I've got people that come to me and they're like, I've got millions to deploy. I want to get money out of the market. I've got people that come to me that have 25, 30, 40, 50K to deploy. So you don't need to be ultra wealthy to do this. When you get into oil, you don't have to have high investment amounts either, but oftentimes you need to be accredited. Now I work with a fund where my partner has participated in over 1,100 wells. So he's got the geologists, he's got the engineers, he's got the land surveyors. We're not going into areas where there's not proven production. These are wells that are already online where we know the production of them. We're buying up leases and mineral rights and land in areas that already have proof of production. They're already permitted wells, and when a well's permitted, it usually is only about 6 weeks before it's actually online. That drilling goes pretty fast. So we're not just drilling new areas and hoping that there's, production there. We're drilling, and I'm participating in horizontal wells. So there's a lot less risk involved with that. And when you drill for oil, usually 3 things come out. You get oil, of course, you get water, because moisture comes out when you're pumping oil, and you get natural gas. Now, if you know the presence of natural gas in that area, and it's highly refinable natural gas, you usually get a premium for that natural gas. Now with oil, you get a write-off on the investment capital. I'll go into detail further on other videos, which I'll include a link in the description for you. You get a write-off on the cash flow. You get 2 write-offs on the cash flow actually, and then you get a really nice exit. Now these oil deals, I just looked at the spreadsheet of historical performance. You've got deals that cash flow anywhere from 13 to 23% in annual cash flow. Now, I'm not taking into account that a lot of times after a few years, these oil deals, it's part of a fund you go into and you sell the future production of that fund to another oil company. So you're cash flowing this, but then you're getting a multiplier on exit, which also you can 1031 exchange. You can do a lot of things with it. But the bottom line is I go into these two assets because I can achieve that 25% here, but I can also do it over here. Usually these ones that are a little lower cash flow are because they're newer. They've only been cash flowing for 15, 18, 20 months. And you're in these deals usually 48 months, 60 months, 72 months. So as the funds mature and more wells go online, they tend to cash flow more. So if I could achieve, even a 20 here, 20% here, even an 18%, and then I take into account that I'm funding using my infinite banking, using my dividend paying whole life policy, not an IUL, not a VUL, but I'm using that line of credit against my whole life, then I take that less the cost of money and I'm able to get that 25%. Now, one more added bonus here before I get to the book giveaway is, so one of the other benefits of these oil deals is if I'm generating cash flow here, this is not taking into account the exit. So a lot of times, all the time, at the end of these oil funds is you're selling that portfolio. You're a small piece in a portfolio of a few investors pooled together. You're selling that portfolio to another oil company and you're selling the future production of all of these wells and what their cumulative production is going to look like over the next several years. So that's another payday to the investors. So you're getting this, but on top of that, you're setting yourself up for a nice exit 5-6 years down the line. That is how to do infinite banking properly. And again, that is why we focus on whole life and not IUL. So if you're comparing an IUL versus a VUL versus a whole life policy, this is why I like whole life. Now you can go to an advisor and you can ask their opinion. I'm just gonna say one thing. If you are incentivized to sell a certain product that has been designed for you by the insurance company and the limited scope of products you're allowed to offer, then what are you gonna do? Because at the end of the day, your livelihood is based off of how many people you can convince to buy life insurance. My livelihood's not based off that. I don't get paid to say this. So it costs nothing for me. It costs something for me to do this. I got a videographer and I got to stand here and dedicate time and could be do something else, but I don't get paid to sell insurance. So just know that there's an incentive involved there. So if somebody has a motivation to tell you something that benefits them, they're probably going to tell you what benefits them disguised as what they think is good for you. I've told you the truths about an IUL versus a VUL versus a whole life policy. You put VULs in the same bucket. Now you know if you want to be able to get more information on how to build wealth with your whole life policy, get access to the oil funds that I use, the real estate funds, even the advisor that I use to be able to get this that I know is ethical, honest, and has your best interest in mind. I've included a link in the description to join the Capitalist Network. This is my own community where we teach people and mentor them on how to take these type of strategies, pay less taxes, partner you with the CPAs, get you into these type of products, and then be able to go invest in oil and real estate that's vetted. And I put all of my wealth building partners that I use, and you don't need that many, guys. You just have a few. You've got the oil guy, you got the real estate, you've got the insurance, you have the financial products, you get the tax help, you put it all under one roof, and we create a strategy for you to be able to actually deploy this, get the mentorship, know what to go into, and not have to go look for real estate or oil deals. I've included a link to the free 7-day trial in the description, and now I actually want to give away a signed copy of my book, American Mediocrity. So this is American Mediocrity. I'm gonna give away a free copy. All I want to know from you guys, drop in the comments what's the biggest life lesson you have learned. Could be about a relationship, could be about business, could be about money, it could be about something from this video. Let me know in the comments. I'm gonna pick one person as a winner. I will reply to that comment, let you know that you are the winner. So just check your notifications, maybe set your notifications on YouTube for that. And once I do, I'm gonna gather your shipping address, I'm gonna sign this book, I'm gonna send it out to you. Appreciate you guys for watching, and I'll see you in the next video.